Active investment, very interesting, as I was saying. Um, so we are going to do a lot of writing, and we're going to do a lot of gisting and a lot of talking too. So what do we all understand by alternative investing? So basically, these are investments other than traditional investments. These are investments other than traditional investment. What do you mean by other than traditional investment? They are basically some forms of traditional investment that we know, which is basically stocks and bonds. So if you are not investing in stocks or bonds, you are probably doing traditional alternative investments. So what is alternative investment generally? Basically when we started, and one of the issues we usually have there is putting our eggs in one basket. I don't know if you guys remember 2008, or 2008 or 2007, or 2000, that year that the market, that stock, what's it called, stock market crashed. Who remembers? Even where I knew there was issue, but when I entered one market and I heard one woman saying that, I have shares, we used to go and buy shares, I think, hey, this thing will soon crash. Obviously, as a portfolio manager, one of the very dangerous things to do is to put your eggs in one basket. For instance, now, somebody comes to meet you and you are investing in shares for the personal trade, or you are investing in bonds for the personal trade, or you are investing in probably real estate for the personal trade. It doesn't make sense because anything can happen. Imagine probably you invested in real estate for somebody now, and government just decided and just said, oh, Lekki axis, it is now waterlogged. Let's clear out all the houses in that place. Okay, imagine you are back to square, you are back to ground zero. Yeah. Or imagine a company just come and say that, oh, you've invested all your money in Keja. Government just wakes up and say, okay, this building or this land, I want to take it up. And they just pay people off. Probably they use power, veto power, and they use something like to take up the stuff. So these are the issues we are having. So one of the main things in life generally is never ever put your eggs in one basket. And I noticed that in life generally, people that fear most, like really scared in life generally, are people that don't have, if you notice even at work, people that are usually very scared of losing their job. People that are usually very scared of losing their jobs, probably they don't have any form of means of any form of means of getting money again. Their work, I probably okay, the worst scenario I'll go back to the business I have at you. You understand? So those are the issues we have. So if you are investing in life generally, make sure you have a backup. You make sure you have a backup. And that's general apart from investment generally, it helps a lot. If you are investing in what's it called? If you are whatever you are doing, make sure you have a backup plan. Anything can happen. I've seen people that probably what they do is just sponsor their kids from the salary they get, and probably some company came up and said, you guys should give. Anything can happen. It's not your father's company. They can tell you to give at any time. So you should always have a backup plan. You understand? So you should always know that anything can happen anytime. They can tell you to leave. I've seen people like that. You might be a diligent staff. I've known somebody. Let me tell you guys, there was this particular guy too. He was so diligent, things were so nice. Even a month before that time, they gave him promotion. The next month, they told him to go. They sacked him. And what could have happened? Imagine there was a claim of, okay, for this happened. But so far, his name was linked to that stock. The management just told him to go. So anything can happen at any time. And that's one thing we should try and realize. So even if you are a portfolio manager, never ever, that's the first rule, always diversify. Always diversify. No matter what you do, never ever put your egg in one basket. Because it is very risky. Anything can happen. If you are putting your egg, let's say you are doing shares alone, or you are doing bonds alone, anything can happen. Government can do anything and probably just break any rule to affect all things. So that is why alternative investment falls in. It's different from the usual traditional investment of you investing in just shares and bonds alone. So I would with everyone, those are like, I want you guys to contribute. It's very short copy. There is a major calculation after some time. I'll teach you how to very easy. But I want to understand the basics why we are doing what's it called? Alternative investment. So alternative investment is you investing in investments that fall other than traditional investment. Let's look start. Other than traditional investment.
Okay.
You investing in other investment other than traditional investment. And traditional investment are usually stocks and bonds. Traditional investment are usually stocks and bonds. So that is basically so you investing in what's it called? Like investment other than the traditional investments, we call it what? We call it alternative investments. Alternative investments. So, what are the futures of alternative investment against traditional investment? What are the futures of what differentiates between traditional investment and alternative investment? Yeah, let's talk. Who wants to help? From the first thing I mentioned, what do you think is the first differentiation? What differentiates? Yeah, talk to me now. There is what? There is portfolio, there is potential portfolio diversification. Let's use that. Potential portfolio diversification. Potential portfolio diversification. So let's note, alternative investments have low correlation with traditional asset classes. Alternative investments have low correlation with traditional asset classes. Alternative investment have low correlation with traditional asset classes.
Yeah. Like,
So number 3, there is more specialized knowledge. You have to be specialized in that field. You have to be specialized in that field before you can invest in alternative investment. Imagine you are investing in the real estate now. You know, what we do now in Nigeria, or basically in Lagos, is everybody is now an agent of selling house. But the truth is, you have to truly know the market before you can involve in real estate or private equity. Somebody will just come and say, okay, I'll charge you 5%, 10%. That's not the real estate you are talking about. Know the market, that's when you can actually invest in real estate. So you have to know the market. It's not like stock and bonds where almost everybody invests.
Thank you.
Let's see now. The fourth one. There is less liquidity of perception. It is less liquid. Unlike traditional investment that you can easily sell your shares and fix and bonds and every other thing. Even generally, if you want to sell a real estate in a fair market price, it's usually very difficult. I don't know if you guys have tried it before. Look at you want to sell a real estate in a what's it called? In a fair market price, in a true market price. It is usually very difficult.
Okay.
I don't know. There was one house we wanted to sell that time, one land we wanted to sell. It took so much time. I think the house was going for, was it 15 people? People were just come. Some people would just come. Okay, we've seen the house. We paid the 7 M. They know that you need it urgently. You understand? We've seen the house. We pay you 5 M. So very ridiculous prices. We've seen the house. We know you need it urgently. I will pay you 4 times. We collect 2 million this month, collect 2 million next month. You understand? So to sell alternative investments is usually very difficult. Please, if you have examples to everybody, please let's contribute. I want it to be a very lively class, please. Okay, sir. Why are you going?
And I say I'm not person.
Okay, for example, I'm making new license. Right? I'm not going to you. Now I will make the best thing of the fight. That's for me after you go into stocks. After the stocks get back down, that will just it's the thing. So
you stop real estate has to be a alternative investment. The single you are the local kind of city, color skaters, you make this. Real estate is great.
Okay, so that was what we said that if you are investing in other things apart from shares and bonds, you are actually doing real estate, you are doing alternative investment.
Like what?
I don't know if that makes sense. So if you are investing in any other thing apart from stock and bonds, you are doing alternative.
That's this way to start to be
I don't know if that okay, please go ahead.
Like this is
nice. To put down that opening that
I thought you
real estate investment. You know that alternative investment we do. The primary investment. So what primary investment is really alternative investment. The page that with perspective of diversify place.
Yes, this percent of an investor, that's the company, right?
And then
Not the person, not the individual putting money down.
so it gives the perspective of non-stress.
Yes.
Looking at the what else are we to invest in the apart from our
Yes.
stocks and this traditional
But another thing you need to know is that if you are a company, you can't be doing everything.
well, Mr. What I think you yourself kind of it's like he's saying for somebody that's willing to real estate, that's what it does that investment.
Okay, so we are looking at it from the investor now.
Yeah, this is so traditional investment. So if
So this is it. We are looking at it from the company side now, not the investor.
what of the professional point of view of
for a monthly bank, for example, your investment do that.
investing. So there are all alternative investment now is not as
That's not the other ones.
so funding investment, for example, as alternative.
Good.
There's only primary doing and investment fund. But also some money.
Yes, I get what you're saying. But you know, we have to give a meaning to it. Like, if we are not investing in what we know, the traditional investment that we know,
Yes, as CFA. It's not as the thank you now
As finance of self.
as now as investment banker.
I think I get what you're saying. So if so to real estate, like they're investing in shares now.
It's alternative for them. You understand? We go to Arnold's and then like no alternative when as secretary extra primary and traditional investment. So the answer to turn into stock and bonds. And most it's them. So then, so looking at life of people like that, like that. I think that
I get your point, actually. I get it.
so I think that's the point is still like started. So why don't these ones are good? Because they are primary to some
Yes.
Bye-bye.
they are primary to some people, they are directing for they are trying.
So I get your point actually, but we also have to look at it from the point of view of the textbook actually. Like if you are not investing, what we know, the normal investment we know is shares and bonds.
Because some person to go and read
Everybody,
everyone.
yes, the normal investment that people should do is shares and bonds. Yes. But if you are not doing those ones, you are doing alternative investment.
That's how we don't see that as myself. Because the concept of them, because if you tell someone that all this life is really investing, that I saying it is alternative, you want them that.
Who was way back, for example, you give money to you know, where you also to be the one. Please.
And that's one thing, but their primary investments is investment. So what they do,
Okay, so we are not looking at it of okay, so this is it now. I get your point. And that's where when you are that point comes in when you are doing reporting. Reporting when you will say, okay, so this is directly related to what we do and not directly related to what we do. Where we put some as cost of sales, revenue minus, you understand? So if it's a real estate now, their top line will be revenue minus cost of sales. So any form of shares will be like maybe other income to them. You understand? So that is now when we are looking at reporting, not in form of investment. So if you are not investing in shares and bonds, you are doing alternative investment. So I don't know if that makes sense. So So if, for example, we have, so for me, how I usually remember on this point is that, look at, if you take real estate, for instance, I can be able to see how to what you call differentiate between alternative investment and what normal traditional investment.
Yep.
So for instance, now to sell real estate, it is usually very difficult, less liquid. I mean, it is less liquid. Less liquid in that it is very difficult to sell because most people can just say, okay, this thing, and it takes time. Somebody can say that, okay, unlike investment that is traded, what's it called, on the stock exchange, you can easily get somebody to buy and sell. But if it is a real estate, it is usually less illiquid. So one of the alternative investment, what's it called, features, it is what less liquid. Let's note that. Yes. Less liquid. So another one is, are we good? Well, there is longer time horizon for investors. You can't just invest in real estate now and say you want to get profit back immediately. Understand? There is longer time. But imagine you are investing in a private equity firm. Private equity firm, what we will soon get there. There are different private equity firms. What some people look out for is companies that are distressed. They look out for companies that are distressed. They go out. The company that is low, they buy it up. They reorganize it, change their management. Let's say they bought it for 50 million USD. Change their management, reorganize it, restructure it. They make sure the profit moves up. Maybe when it reaches maybe 300 million USD of the share price, they sell it, make their money and exit. Imagine if you invest in that kind of what's it called? Please, you can help us with your mic. If you invest in that kind of real estate, right, that kind of alternative private equity, for instance, now, and you want to collect your profit back, it will take time. Let's say they buy it in they take it off in 2024, maybe 2034, that's when they get their returns back. You understand? So it's usually very difficult to get your money easily. So it takes a longer time horizon for investors. Longer time horizon for investors.
We have a producer of company.
So that's it. So imagine investing in private equity. I've seen so many, and that's where the real what you call real investment is. All those what you call private equity. They look for distressed companies. They look for so many other things. Very interesting. If you're in that part of that field, like you really enjoy yourself. Another issue you will see is another characteristic of what you call traditional alternative investment against traditional. There is low regulation. There is low level of regulation and transparency. Have you ever seen a private equity account outside? Or a real estate account outside? You never see it. There is low level of regulation and low level of transparency. Like a listed company, like a GTB, you send it back, but you see their companies, their financial statement outside. Right? Low level of regulation and low level of transparency. So there is also, imagine we invest in like a private equity firm with distressed organization we talked about. You invest in 2024. Maybe to get your money back, you get your money back in 2034. Imagine, so there is usual restrictions on redemption or lock-up period. Let's go to that. There is restriction on redemption or lock-up period. You can't just wake up today and say you want to get your money back. There is usual restriction on redemption or lock-up period.
Yes, that's one thing. But not to the back.
Very good.
Yeah.
Any question?
Come. Wait. Back. Good.
And lastly, there is high fees because of active management. So usually there is high fees because of active management and expertise. Imagine you are investing in the real estate now. That's why you saw those agency fees. Somebody will come and say, agency fee 10% of the total, whatever. You understand? Or you're investing in a private equity firm that you don't even know, you don't even have idea of how it works generally. Somebody will just come and say, okay, invest here. They will charge you maybe 5%, 10%, or imagine you're putting 50 million USD. They're charging 5% or 10% of 50 million USD. Are we good? So that's high fees because of active management expertise. Let's look at high fees because of active management expertise. Please, any questions? Okay, so there are different categories of alternative investments. There are different categories of them. I'll take them briefly and just explain those things. So one of them is private capital. Private capital, which include private debt and private equity. Private debt and private equity. Private debt and private equity. So private equity would be probably like leverage buyout, venture capital. All those people that invest in startup, right? Startup, and so on. So when we talk about all these things, the private debt. Have you noticed there was a time I heard that I don't know how true it is so that there are some individuals that borrow government money. I don't know if you guys remember, I heard that MK Abiola used to borrow Nigerian government money that time. I don't know how true it is, so it is. I don't know how true it is. That the guy had so much wealth that they usually go and meet him that time. They will tell him that they need money and he will borrow their money. So these are form of private debt. They come and direct. So companies can borrow, or governments can borrow money directly from. I don't know how people are laughing. Is it true? So that those private debt, there are some people that borrow money directly from individuals or skill or loss here. Okay, so that is private debt and private equity. Then we have real assets. Real assets, which include what? So real assets, which include real estate. Let's look at real assets include real estate. So real estate is the full topic on its own level. So real estate is the full topic on its own level. Then we have infrastructure. Real estate is the example we've been giving all through. That somebody comes and say, oh, you want to buy a property, whether it is through commercial and so on, you want to buy it on your own and so on. Then we have infrastructure. You might have a private government investor saying, okay, let's build the toll gates. Let's do the toll gates. And you guys will be paying. That's what they did in Lekki toll gate. So you guys will build the toll gate or build a bridge. And you guys will be collecting money in private government partnership. The natural resources. We have commodities. Commodities is a full topic on its own in the where you have commodities, where you have coffee, crude oil, crude oil in there. So you have two different types of crude oil, light crude oil, and so on. Very interesting topic. Light crude oil and heavy crude oil. Then we have whatever. So, but when you get to talk more on this one, that's the natural resources. Then we have other assets. Other assets which include digital assets. Then they brought in cryptocurrency now. Cryptocurrency, all those token and so on. So we'll talk about them briefly. So that is real assets. I want to get that news online. Can you hear me? So the next one we'll talk about is hedge funds. Hedge funds. So we looked at we talk about this too briefly. Hedge funds. So what are hedge funds? So hedge funds are investments companies that use different strategies. They use short, long, they use derivatives and so on to achieve their aim. They use leverage, they use derivatives, they use short, they different type of strategies to generate their investment gains. Come on. Wait, takes a bit. What the fuck? So they use long, short, derivative, leverage, so many things to achieve their investment gains. So we'll talk about all these two briefly. Talk about all these two. So let's go ahead. So there are different types of investment methods. Investments. There are different types of investment here too. We are going to talk about 3 types of investment methods. So if you want to invest in a what's called alternative investment, there are different types. One of them is fund investing, co-investing, and lastly, direct investing. Fund investing, co-investing, and direct investing. So how does fund investing work? Fund investing. So so fund investing. So fund investing, co-investing, and direct investing. Fund investing, co-investing, and direct investing. So fund investing, let's look at it from this angle. This is the simplest. Let's note, fund investing is the simplest. Fund investing is the simplest. So how does it work? Before I give you the definition. So somebody comes to meet you and say, oh, you as a private equity organization, I want to put a money in your company. What you're just going to do is invest my fund and get in returns. That is fund investing. You putting money in the fund, expecting return. So you don't need to pay. You don't need any form of thinking. You don't need any form of thinking. You don't need any form of what you just look for is just your returns. You don't need to follow those big IBTC, like what you invest in what is it called? Mutual fund. I mean, you investing in mutual fund. All you do is this is nice. Okay. This is nice. So what you do is I'll just put my money there, you invest for me, and what I'll do is I'll just get returns. Does it make sense? So that is fund investing. So that's right. So the investor contributes capital to a fund. The investor contributes capital to a fund, and the fund makes investments, on behalf of the investor. The investor contributes capital to a fund, and the fund makes investments on behalf of the investor. So the investor typically charges a fee. So, what are the advantages of fund investing? That's right. Advantages of fund investing. So, number 1, low level of investor involvement. Because I put my money down, I don't need to bother myself. What I'm not waiting for is just profits or dividends. Like I said, low level of investor involvement. Number 2, access to alternative investment without possessing any high degree of investment expertise. So you have access to alternative investment without possessing a high degree of investment expertise. So it's just like you're investing in alternative investment without even knowing to read at all. You need to bother yourself. Access to alternative investment without processing. Access to alternative investment without processing a high degree of investment expertise. To fund investing, like we said, is the simplest. What you just need to do is just put your money down and probably enjoy the rest. Just sit down and relax. Put your hand down, be expecting that the profit goes up. You understand? So there's no much stress. So advantages: lower level of investor involvement, access to alternative investment without having a high degree of investment expertise, then lower minimum capital requirements. Lower minimum capital requirements. So me, I disagree with that one. If you want to invest in not just anyhow person invest in private equity, it's huge funds of money. Even to do
One. Yeah, it's hard.
even to what it called,
You work. I mean,
even to invest in. So if you want starting to manage your investments, starting to manage your investment, like you not just all these mutual funds and any other thing. Proper manage your investment. At least a minimum of I think maybe 100 million. For you to don't start managing your investment program. So well, if you say lower minimum capital requirement, so I think that's there. So disadvantages of disadvantages of fund investing.
but proper picking.
Disadvantages of fund investing. That's right.
How do I do it?
Costly management and performance fees. Costly management and performance fees. Investor must conduct thorough due diligence when selecting the right fund. Investor must conduct thorough due diligence when selecting the right fund. So imagine you want to invest in a fund and you go and check, send somebody to check, be careful. Is this a real estate? Hope they will not take my money and run away and stuff like that. So you as an investor, you must conduct thorough due diligence.
Not as a quick.
Investor, this is what we talked about. Investor are less able to exit the investment fund. Investors are less able to exit the investment fund. They are less able to exit the investment fund, typically because they have lock-up periods. Typically because they have lock-up periods. Are we good? Can I go ahead? So the next one is co-invest. Co-investing. So this co-investing now, probably I've worked with the Stanbic IBTC and I've seen the way they do their private equity and what's it called? Real estate. I mean, what I would just basically do for my end is that I will start replicating what they've done. Are we with me? So that is co-investing. That is co-investing. That is co-investing. So you are in between. You are not putting your money in the fund. You are not doing direct investing yourself. Probably you've seen what they've done before. You are just replicating what they've done. So let's go ahead. Co-investing, there is reduced management fee. There is reduced management fee. Number two, investors can learn from fund process to become a better investor. Investor can learn from the funds process to become a better investor. Number three, investment allows more active management. Investment allows more active management compared to fund investing. Compared to fund investing. So more active management compared to fund investing. So let's look at disadvantage now. So one of the first disadvantages is that this may be subject to adverse selection bias. That's right. This may be subject to adverse selection bias. So you as a co-investor feel like, okay, I'm going to buy houses in low. I'm going to buy houses in Ikeja in low. So it may be subject to adverse selection bias. So once you are selecting that, you can just decide that, okay, I'm going to be only I'm going to be buying houses. It's really so investment I want to be doing. Are we together? Those are like, can you hear me? So that is co-investing, right? Co-investing, reduce management fee. Investors can learn from funds process to become a better investor. So co-investing allows more, yes, right? Allows more active management. Okay, disadvantages, right? Oh, okay.
How much?
Okay. So the first one was there is what? Yes, adverse selection bias. Number two, there is reduced control. There's reduced control over the investment selection process. There's reduced control over the investment selection process. So co-investing requires active involvement compared with fund investing. Co-investing requires active investment compared with what? Fund investing. So the last one now is direct investing. Direct investing. So direct investing requires the investor to purchase the investment, the alternative investment himself. Requires the investor to purchase the alternative investment himself. So advantages. So direct investing avoids paying management fees. Avoids paying management fees to external managers. So there is great amount of flexibility for the investor. There is great amount of flexibility for investor. There is great amount of flexibility for the investor. There is great amount of flexibility for the investor. So imagine you are investing in a direct investment yourself. Automatically, you will not be paying anybody for management. You just go, okay, I want to buy a house here. You go to Bodilon, buy a house. You need this one. Go to Hedge, buy a house. So you're not paying any management fee to anybody. And also, there is amount of flexibility, great amount of flexibility. So you can decide to do anyhow as an investor. So lastly, advantage of direct investing, there is the highest level of control over how the asset is managed. Highest level of control over how the asset is managed. The last one says what? Let's now move to disadvantage of direct investing. So requires more investment expertise, less access to funds and readily diversification benefits. Less access to funds and readily diversification benefits. Then also requires more complex due diligence. Please, any question? So what we are now going to do is we are going to take each of these alternative investment one by one. We are going to take them one without a row. So are we ready? Oh, you know what we'll do? Let's take some questions. I think to cement what we've done so far. So I want you all to help me. So what's number one? Can you all see my screen? Number one. Hello.
I think B or C.
Okay, which one specifically? So explain why B or C.
Yeah, just the definition method. I don't think it's less liquid.
Okay, so compared with alternative investment, traditional investment tend to be what? We just gave the what you call characteristics now.
Sure.
Characteristics. So if you remember check the characteristics I gave you and then check the answer that you confirm. I want you to get it. That's why I'm emphasizing on it.
Your goal is lower fees.
Lower fees. Okay, so what they are asking you is if you are not using alternative investment, so the traditional investment tend to have traditional investment are usually highly liquid compared to alternative investment. Remember that private real estate is difficult to sell them, right? It's difficult to sell them. Then the next one is have lower fees. Traditional investments have lower fees compared to what's it called? Real estate. Real estate have higher fees because you have to pay a lot of management fees and so on. You understand? While alternative investment requires more specialization. So the answer is what? B. The answer is B.
First topic.
Okay. So let's do number 2. Number 2. So we did number 1 earlier, but probably we missed it. But it's something you can go to look at. This is number 1.
Let's take
Number 1.
okay. But if you don't, I'll pick up your look. I think you can take position. Actually,
Box.
the description of
Okay, so why C?
like these things.
I felt got it out. Yes,
Yes, traditional investment. It's traditional investment or alternative investment.
right.
So it's alternative. It's alternative. You understand?
So traditional investment tends
Compared with alternative investment, traditional investment tend to
stocks and your box. I traditional investment.
see anybody trades bonds. Everybody can trade shares equity now. But it's
Or invest.
trade, even trade, so small person can just start trade there.
I don't know. Not really strong box.
So you have to be so the thing is the question are easy. So you have to be very careful. That's how they tend to be very funny when they ask questions.
I've added facing.
That's one good thing about answering a lot of questions. You'll be fine. By the time you answer a lot of questions, you'll be fine. You'll be fine. By the time you answer a lot of questions, you have seen solve all the curriculum questions, your mock questions to solve them, then you'll be fine.
So how
So it answer about what?
The answer is what? What did we go for when we agreed? B. Let's do number 2.
but how the book comes up out of the thing. Just one of the different papers that we have realized it's how
Million pounds.
this is possible. To list that word, it's not invest. How who's
One, investing.
that we have to find. I could be
Oh yeah, we were like number 2, those online, so I need to hear from you guys.
what comes from that.
So we just discussed it now, the characteristics.
But
I think your goal is
Okay. Okay, any other opinion?
was very quick.
So I think B is the right answer too. So if you don't have any form of knowledge, and probably want to invest in alternative, the best just go for fund investment where they manage it for you. Are we together? So we'll look at 3 and 4 later. All these committed capital assets, what's it called? We'll look at them short. So that's good. So let's continue. Yeah, we're on the right track.
You could so
So
to
let's start with private capital.
out
Private capital. So let's go.
it
So what are private capital? What are private capital? Who wants to help? We just defined it shortly. Anybody wants to help?
We can keep a part of so on the activity button. Go to the
So when you talk about private capital, please, it's very important. When we talk about private capital, these are funds provided by companies that is not raised from the public. These are funds provided by the company that is not raised from the public. There are two forms. It's either it is a private equity or private debt. It's either it is private equity or private debt.
why?
So we take private equity first of all. Let's start with private equity. Private equity.
What's the compute?
Private equity. So private equity, let's write. Private equity is investing in a private company. Private equity is investing in a private company or investing in a public company with the intent of taking them private. Investing in a private company or investing in a public company with the intent of taking them private. So the thing is, whenever you are investing, have you noticed, we are going to be giving real life situations here. Have you noticed Skybank? So investing in a private company or investing in a public company with the intent of taking them private. With the intent, have you noticed Skybank? When the private equity firm wanted to take over Skybank, what they did is they took it away from public. They listed their shares on the public. They brought it to Polaris Bank. They are not trying to restructure it, make it liquid. When they make it liquid, they will now probably sell it again. Are we together? So that is private equity. Who wants to give me another example of a private equity? Thank you, that's a great one. Thank you very much. I think we're talking about the tech, right? Makes sense. So I want to. Sorry, I didn't get that. Hello, you say so? Oh, okay. Can you hear us now?
Come.
Okay. So we are talking about the tech, Abby.
That's fine. Yep. But you are
Okay.
how about it?
So a very good example. So like I said, don't worry, examples will come up, like we will say. But remember the one of Skybank. What they did was you can't a private equity firm cannot acquire a public firm. So even if they acquire a public organization, what they do is they take it private first before they start operating on it. Very good. So there are different, let's write, there are 4 types of private equity. Leverage buyout. Please, everybody, let's take notes. Leverage buyout. Number 2, venture capital. 3, developmental capital. And lastly, distressed investing. So let's take them one by one. So leverage buyout. So this is when you acquire a company. Let's write. This is when you acquire a company through significant debt financing. So leverage buyout capital structure comprises of equity bank debt. Leverage buyout capital structure comprises of equity bank debt or high yield bonds. So there are basically 2 types of leverage buyouts. Management buyout and management buy-in. So management buyout, the current management team purchases and runs the company. While management buy-in, The current management team is replaced. The current management team is replaced, and the acquirer team runs the company. And the acquirer team runs the company. So target companies of leverage buyout. Target companies of leverage buyout. So the companies that leverage buyout looks out for. We have undervalued stock price, winning management, inefficient companies, undervalued stock price, willing management that is willing to sell, winning management, inefficient companies, low leverage, companies with low leverage, strong and stable cash flow, the companies with lots of physical assets, it's a target to categories. So if you have a lot of physical assets and they're not managing your company, people are hiring you. People are looking out for you, like, okay, we are waiting for you. Lots of physical assets. Okay, so venture capital. So venture capital invests in a private company. Let's write. Venture capital invests in a private company. Venture capital invests in a private company with significant growth potential. Are we good? Venture capital investing in a private company with significant growth potential. So venture capitalists are actively involved with the companies in which they invest. Venture capitalists are actively involved with the companies in which they invest. So please, let's pay attention to this very well. It comes out a lot, and I want you guys to pay attention. So venture capital stage, we have stages in venture capital. There are different stages in venture capital. So the first one is formative stage. So these are companies that are in process of being formed. Let's take a look. These are companies that are in process of being formed. What is ANGEL? ANGEL. What of ANGL? So angel investing. Out of that formative stage, now we have angel investing. So when you say you are investing in angel investing, means financing is provided at the idea stage. Please, let's take note. Idea stage. Financing is provided at the idea stage. Please, let's take note of that, the idea stage. So if you are investing in angel investing, the financing is provided at the idea stage. Number 2, seed stage financing. Seed, S-E-E-D, stage financing. Seed stage financing. Seed stage financing. So financing for product development and market research. So seed stage financing involves financing for product development and market research. Financing for product development and market research. Financing for product development and market research.
I get to go to the also.
Financing for product development and market research.
Speak of the how to develop.
We've seen angel for investing, seed stage, then lastly, early stage. Early stage. Early, that is early. EARLY. Early stage. So this is financing for company moving towards commercial production. Financing for companies moving towards commercial production. Moving towards commercial production. So move to number 2 now. Later stage financing. Later stage financing. What is your call? Three sub. Angel investing, seed stage financing, then early stage financing. So the next one is later stage financing. Wait, later stage financing. So this is for expansion. This is for expansion. After commercial production and sales, but before IPO. After commercial production and sales, but before IPO. IPO, initial placement offer. IPO, initial placement offer. And lastly, number 3, mezzanine stage. Mezzanine. I think I'm correctly pronouncing. Mezzanine stage. MP. Let me do that.
It's correct. They're like other elements like
This is the mezzanine stage. Mezzanine stage. So this is when you invest in a company that is preparing to go public. Investing in a company that is preparing to go public. That's right. Investing in a company that is preparing to go public. Okay. So I want you to help me with this. So just listen and just tell me the answer. The stage in which capital is gathered for product development and market research is called what? A, formative stage, B, seed stage, C, early stage. The stage in which capital is gathered for product development and market research is called A, market research, seed stage. You said I don't say C. I hate C. The seed stage, I meant seed stage, right? Thank you. These are the type of questions we see. So you have to know each one of these states very well. They like this question very well. People make mistakes very well. So what are the exit strategies? Exit strategies of a private equity. One, trade sale. Trade sale. So this is when you sell the company to a what? A strategic buyer. So when you are done with reorganizing, doing whatever you want to do, you now sell it to a strategic buyer, which is trade sale. Let's move to trade sale. Number two. IPO. Initial public offer. Number 3, recapitalization. Number 3, recapitalization. While lastly, secondary sale. Secondary sale is when you sell to another private equity firm. Secondary sale, sell to another private equity firm. Sell to another private equity. And lastly, right of manipulation. Right of manipulation. Private debt. So this includes debt provided to private entities. This includes debt provided to private entities. Private entities. Private entities. The forms of private debt include direct lending. Let's note that direct lending. Direct lending. Direct lending. Mezzanine loans. Mezzanine loans. This provides subordinated debt. This provides subordinated debt. Provides subordinated debt. So you know those bank gets paid first, then you know the way it is subordinated, right? Everybody, are we together? You've done this in your fixed income now. All those subordinated to senior secured debt. Bank gets paid first, then like that before you start ranking it. The next one is venture debt. Venture debt. That's right, venture debt. Private loans to startups or early stage companies. Private loans to startup or early stage companies. Private loans to startup or early stage companies. Private loans to startup or early stage companies. While lastly, distressed debt. Yeah. Distressed debt. Private loans to distressed companies, e.g., companies facing bankruptcy. Private loans to distressed companies, companies facing bankruptcy. Company facing bankruptcy. Are we good? Those online, are you guys fine? You guys have been very quiet. Are you guys fine? Online people, are you guys fine?
Yeah, it's fine.
Okay. So let's go ahead now. So help me with this. The questions of the screen. Questions of the screen. Okay, let me see. In which stage of financing are most likely to make its initial investments? We agree, say.
How come we seed capital?
We go what? B. Oh, okay. Yeah, what's the answer? Which one should we go for now? Initial investment. Firm's development, Abby. So I think the answer is seed. That is B. Thank you. So number 2, please. Number 2.
So what do you call the answer?
B, seed capital. You can see from all the things I gave you, you will see the answers there. You can see, if you see the stuff again, you see seed financing, product development, and market research. You can see. So firm's development, when it is product development or firm's development, you go for seed capital. Number 2, C. In a secondary sale, the private capital firm sells one of its portfolio companies to what? To another private capital very clearly. You can see we've actually touched everything. Just follow the notes and you're fine. Yeah, let's quickly look at this tranche debt. Let's look at number 4. Then we'll look at on tranche debt, so we'll be fine. So number 4. Oh yeah, number 4, help me. Number 4.
Okay, that is. Help.
What's number 4? Which type of private capital fund is most likely to earn excess return over its life or its guilty will? Excess return. Oh yeah, talk to me. When you hear distressed, when you hear economic contraction,
Watching media.
which one do you think would thank you
And
benefit?
guys.
Those online are you fine? Let's move. The next one is hedge funds. Let's take hedge funds.
Yes.
Down.
Okay, two. Let's
So hedge funds, let's write hedge funds.
table to the
Hedge funds. So the purpose of this fund,
Jesus.
was to hedge long only stock portfolio. Was to hedge long only stock portfolio.
Robert.
The fund followed 3 key points. The fund followed 3 key points. Number 1, always maintain short position. Always maintain short position. Number 2, always use leverage. Always use leverage. Number 3, only charge an incentive fee of 20% of profits. Yeah. Only charge incentive fee of 20% or profit. Only charge incentive fee of 20% or profit.
Like what?
So characteristics of hedge funds.
What's in great? Them. Change up.
Characteristics of hedge funds.
That you should
So they are usually aggressively managed portfolio. Usually aggressively managed portfolio. Usually aggressively managed of portfolio of investments across classes. Aggressively managed. Aggressively managed portfolio of investment across classes.
I'm going shopping.
So another thing is there is often imposes restriction on redemption.
Get time. Working.
Really? It often imposes restriction on redemption. So there are different hedge fund strategies. Different hedge fund strategies.
Working.
One of them is event-driven strategies. Event-driven strategies, which profit from, one of them is event-driven strategies, which profit from short-term events. Profit from short-term events that are expected to affect individual companies. That are expected to affect individual companies. Example, major, distressed and restructuring companies, the special situation companies. We'll talk about all this. We'll talk about it. The next one is relative value strategies. Relative value strategies. Relative value strategies. So this involves fixed income convertible arbitrage. Fixed income convertible arbitrage. Then multi-strategies. Multi-strategies.
Let's go to
Multi-strategies.
what before.
Number 3, so macro strategies. Macro strategies. Macro strategies. This profit from economic trends. This profit from economic trends.
What up?
This profit from economic trends, evolving trends across the world. Economic trends and evolving trends across the world. So trades are made based on expected movement in economic variable. Trades are made based on expected movement in economic variable. Trades are made based on economic movement in economic variables. Lastly, equity hedge strategies. Equity hedge strategies. Equity hedge strategies. So this profit by taking long and short position. This profit by taking long and short position in equity and equity derivative security. With equity and equity derivative security.
Let's get
example, market neutral, fundamental growth, quantitative directional, short bias, quantitative directional and short bias. Quantitative directional and short bias. So any question, please. Those online, let us speak to us. Any questions, please, or type anything.
There is no question.
Okay, so we are moving into hedge fund fields now. Hedge fund fields.
Good, sir.
Good luck. Good. So we start that one now. Let's start hedge fund fields well. Those are like I hear me. So we are going to look at how to calculate hedge fund fields. How they go about their calculation, the management fee, the incentive fee, and share. We'll continue next class by God's grace.